usually on like if it's residences, it's 5 units or larger. You can usually with a standard carrier, a 1 to 4 unit, you could really get on a regular policy often. So usually you're thinking, 5 units or larger for something to be considered commercial. But there are going to be different coverages that you're going to need on that property because there are different moving pieces here. Um, so the first one you're going to have is the general liability. That's what most people think of as a slip and fall coverage. That's all the fun lawsuits and all the fun, lawyers that have all those fun signs out there that we all have to deal with that drive insurance prices up because everything's on contingency. So everyone's just trying to get a buck out of it. Um, what did I just, yeah. So general liability,
Oops, I'm sorry, Ben. There you go. It came back. Never mind.
I'm
Go ahead.
back. Oh,
Yep, all good.
right. So general liability is going to cover those. The question obviously is how much. Most companies on a smaller one are going to have a 1 million per occurrence, 2 million aggregate. You can always up that. I've had ones where it's been 2.4 or different, or 3.3 or 4, right? Depending on the carrier, what they'll offer. Later on, we're going to discuss umbrella possibly as a way of supplementing that. It really depends on, again, in the market that you're in, and the type of property that you have, and different risk factors, how much you want to have, in other words, what the types of losses that you have to protect yourself from are going to be. But, let's just assume you're starting with that 1 million per occurrence, and that should usually be safe, barring something really catastrophic. Again, that's not covering the property, that's covering, if someone gets hurt on site. On the property side, a big part of what you're going to see on a policy is replacement cost coverage or actual cash value coverage. I would always say go with replacement cost because actual cash value is going to leave you with this massive gap due to the fact that it takes in depreciation. Um, so at least when I was selling, years ago when I was selling, home and auto, it was always like, well, if you take the actual cash value, think how much your 10-year-old couch is worth, or your clothes that are, you've worn them for, right? You're going to get pennies on the dollar for your, for your house. So here, when you're buying a building, like you don't want it to be like, okay, well, it's a 80s build. You have all that depreciation. Um, you're not going to get enough to rebuild it. So you want to go with the replacement cost. Contents is usually not your responsibility as a landlord, except for the things that are yours in the contents. So like unattached, non-attached to the house appliances. So if you have 10 units and you have, a fridge and a washer dryer in each one, things like that you may want to cover because those are yours. But contents should really be covered by the tenants on a renter's policy. Lots of ways to get that into your lease or highly recommend it. There are even some programs, depending on the size of your portfolio, where they'll let you kind of broker it through them. Again, that's a whole different discussion. But again, you want them to have that because that protects you and avoids the really awkward phone calls and discussions around, well, why didn't you insure my stuff? It's like the number one rule of insurance is that you have to have an insurable interest in it. And as much as you may love your tenants, you don't really have an insurable interest in their flat screen TV. A very big one that's important, and should be on any policy that you're getting as a landlord is business interruption. Sometimes we call it loss of rents. That is going to cover if you have a claim. It's not if someone moves out, but if you have a claim that's covered. So let's say, God forbid, you had a fire in one of your units, or it was one of the units and infected several of them. There's coverage for the loss of income from those units while it's being fixed. Again, if this is something that you're trying to make passive income off of, or if you're actively managing it, it's really important if you're going to have 3 units out for an extended period of time that you're getting that income because you need to pay the mortgage on your building. An
Can
example.
I can I give you an example real quick,
Sure,
Ben?
go ahead.
What's going
Yeah.
on right now with me? So I have, in case people didn't know, that a lot of Spokane, Washington is on fire, and I have 3 apartment buildings in Spokane, one of which is under evacuation orders.
Oh, wow.
So you can't really collect rent um, from people when they aren't there. At least I don't think we can. And so I see business interruption, me calling the insurance agent, please don't let it burn down, say, but also business interruption. If people have to be away for 3 or 4 or 5 weeks, would that be
Yep.
an example?
Yeah, that's a pretty good. I mean, again, the only difference there being, and it depends on policy terms, but an evacuation order may qualify for that, but usually it's when there's a claim, like a physical damage to the building.
Oh,
Usually, again, I'm not going to say in every single case, but usually it's when there's a physical claim that prevents it from being used. So again, I'm not looking at your policy at the moment, so I can't say one way or the other, but usually it's due to that versus,
okay.
there are other things that you can do. I've seen like really niche products that sometimes people do around like, like kind of covering like if someone moves out for an extended period of time, but that's not usually what it's talking about. I hope that answered your question. Okay, hired and non-owned auto. So this is one that comes up a lot if you're running a business. If you have employees that are driving their cars for work, and let's say they're out on official errands for the business and they get in an accident, you don't want it coming back to you or coming back to them, really to the business. So that is something that we sometimes see with landlords. Most people drive their own car, but if you're on a work thing, you don't want it being the business's liability. So that is usually something that you are able to add. And then we'll see there are some other coverages you can add depending on your scenario. Okay, the first thing you're going to see when you get an insurance proposal or when you get the actual policy is the deck page, as it's called. It's short for declarations, not an actual deck. And these are kind of all the things you're going to see on there. You want to make sure that they all line up with what you expect. Obviously, the insurance company and policy number that's on their end, but you want to make sure that the named insured is correct and the address, right? You want to Oftentimes, and we see this a lot with property investors, there is an LLC or there is another name for it. You want to make sure that the named insured is the right person or the right entity. You want to make sure that the address of the location of the property, number 5 over here, is not if it's not the same as number 3 with that address, you want to make sure that it has the right place for that building. And then it's going to get into your coverages. As you see, we have a replacement cost on there. Deductibles we're going to get into a little bit later, but they could be different for different risks, different perils. So on this one, for example, you see how there's a separate wind and hail one, and then there's all other perils. So again, that's going to be something we're going to see later, especially when you're talking about things like fire or hurricane or flood, right? Where there's going to be possibly different deductibles, and therefore, if you're having a claim due to a storm, it's going to be different than if, someone, God forbid, broke in. Um, Limits are exactly that. An insurance policy is a contract. And if they say they're covering it for $1 million, when it gets to $1 million and $100 over that, that's no longer the responsibility of the insurance company to cover. Sometimes there'll be endorsements or other things that will extend that coverage. We'll get into that. And then also on the liability side, that's why an umbrella is so important because a lawsuit could exceed the liability limits in the underlying policy, but you can add that layer. Okay, exclusions are probably one of the biggest things in insurance. This is always the stuff that people are like, oh, well, it was in the fine print in the back. Um, it varies by the carrier, it varies on the policy. There are things, especially on the commercial side, that you're able to sometimes negotiate back in. If you have a broker that has a good relationship with underwriting and you're able to show in good faith that you are working to fix something that was a problem before, or like let's say you updated the roof or the plumbing, and that's going to make it that it's a more desirable risk, or if you have certain procedures in place to avoid certain issues, right? So, but there are going to be exclusions on every policy. Usually, exclusions come out of there not being an exclusion and insurance companies getting sued multiple times on the same issue. So like the classic example would be during COVID, there was not necessarily always a, virus exclusion on some policies. there really was from SARS, but that ended up with lots of lawsuits and lots of settlements and different things. But now it's very clear cut in every single policy that there's an exclusion for that. Um, Oops, sorry. Um, a very important one on the property side to mention is flood. Flood is never covered on a standard policy. You could see that there's an endorsement for water backup on there, which again is usually from a sump pump or from some other interior water source. But that is not the same thing as flood. There are different types of flood. I'm glad to send out some stuff on that. I have there three different types, and there are lots of cool names that are Latin, and I don't know them by heart right now. There's fluvial and some other ones, and it depends on how the water gets in. But flood is a separate policy. That's why there's the entire flood insurance. It's kind of like terrorism insurance. After 9/11, it's one of those things where the government has to kind of back it up and create a fund, kind of like FDIC for banks. It's no insurance company is able or willing to take on all the risk from that. And you see this a lot with hurricanes and named storms, where you get into these issues. Again, if you're investing in states where that's a reality, I just spoke to a guy on Friday in Florida who told me a whole fun story about a claim they had back in 2005 and a bunch of lawsuits back and forth with a insurance carrier because they had six carriers that divided the risk on the building. This is a large condo association. They had six different carriers on there, and there was a clause in the contract that basically said if any of the six don't cover something, it applies to all of them. And they kind of sued the agent, and they said whatever. It settled for millions of dollars, but it was one of those things where you really need someone to be checking the fine print, especially when you're building a tower like that. I don't think that anyone here is looking to build that right now, but on those types of things, right, the exclusions are really where you got to be careful in a policy. Okay, different types of policies and or names for them and when you're going to need them. So I talked about this with James and Nicole when we were talking about this class. Depending on the carrier, your policy for a rental property could be a landlord policy or a dwelling fire. Oftentimes when I write them through smaller company, like a mutual company, they'll call it a dwelling fire, and everyone's like, "What's a dwelling fire?" It basically means that you're covering the building, but not the inside, because that is the tenant's responsibility on their renters. Most commonly, you'll see it as a BOP, which is a business owners. Um, and then you get into, well, if you have a building that is vacant, and vacancy can really depend carrier specific, whether it's 30 days or 60 days. Sometimes you can extend it via an endorsement. But for the most part, if you're going to have a building that is going to be vacant for an extended period of time, it's a different policy form. It is different, it's not necessarily different risks, but it's a different weight to those risks because you're not dealing with people constantly being there. So whereas you're not so worried about, a slip and fall because there's no one there, although that could happen and there's no one there to know about it. The real thing you're worried about on a vacant is something failing and no one being there to turn it off. If someone's home and a pipe bursts, or someone's home and there's some other issue, it usually gets caught pretty quickly. A lot of times where we see this is with pipes freezing, is a big one with vacant properties. And a lot of carriers will have rules around what you have to keep the heat set at or what you have to, other things to prevent that. Because if you have a building that's sitting all winter until your, team can work on it, excuse me, and and you have some frozen pipes. I've seen some interesting pictures of, frozen waterfalls coming out of the ceiling, and it's a month before anyone looks at it. Um, so that is something to think about. Again, if you're going to purchase a property and sit on it, until you can get to renovating it, which is going to be the next step, which is the builder's risk, you can, it should be on a vacant form, not on a standard form. Builder's risk is the course of construction insurance. So that could be ground up. So it could be a brand new build, or it could be a renovation. A lot of people are doing flips, whether they're to buy and hold or to sell. This is the form you're going to use. You don't want to put that on a standard policy. It does not cover that, and it's not worth the amount of people that have called me and said, "Oh, well, we had a homeowners on it, and there's no one living there, and they're in the middle of doing construction, and there are all these issues." That is not going to cover it. So, a builder's risk policy is where you want to go with that. It has pieces of the vacant coverage in there because it is obviously somewhat vacant. It's not occupied, but there are people there constantly. That is one of the questions on the application. whether, how often someone is checking on the building. And it also has coverage for materials, which is really important if you're going to have stuff dropped off. Um, then you want to make sure that's covered if someone decides to walk away with your copper, which unfortunately happens a lot. Um, and then if you're someone who's doing that at volume, there's something called a reporting form, which is where you are essentially having a spreadsheet that goes back and forth with the insurance company, and you are letting them know where in the process those policies are. I'm sorry, not the policies, where in the process those buildings are, so you can put it on or off depending whether it's, vacant or course of construction, or then eventually you'll move it onto a regular standard form.
Can I ask a question?
Sure. Go ahead, Nicole.
So is this reporting form the same thing as if you have, I'm making this up, 3 or 4 buildings and you're selling one or you're building another, and so something has come on and they go off? Is that go on something like a reporting form, or is that
Yeah.
called something else?
Yeah. I mean, you could have a master policy with a bunch of things on there, but that's usually on the buy and hold side. The reporting form would be if you're moving things through the process. So that's usually if you have a guy who's, let's say he's flipping a bunch of stuff, right? So he's going to have stuff that's in the vacant phase. He's going to have stuff that is, in the course of construction. And then eventually things will move off as he either sells them or, decide if he buys and holds them, he can move them on to, a standard, landlord policy.
So you don't have, does that mean that you wouldn't have to have a separate insurance policy for each and every property that you
Yes.
add and delete
If you're,
as?
yes, if you're able to do, right, if you have a reporting form and you have the SOV, which is the statement of values, which will have, you know, the address, what year the building is built, what you're doing to it, what the renovation budget is, all of that on there, and you keep them updated on what phase it's in. Yes, there is a possibility with certain carriers to have that as one flow as opposed to having a bunch of different policies.
Thank you.
No problem. Okay, now we get into some of the less exciting things that people worry about with insurance, and this is kind of where you get into some of those deductibles. The big one that we saw in the policy before, and that definitely in places where it's more prevalent. So I always think Texas. I know I worked on a building in Houston that the wind hail deductible, which is obviously for storms, so anything affected by wind or hail, which comes with it a lot out there. The wind hail deductible and that portion of the premium to cover that was basically the same as the premium for the rest of the policy. So, if you buy a building out in Pennsylvania or the same building in Texas, you're basically paying a lot more to cover the risks that they have out there. So wind hail deductible, depending on the carrier, can be a different number. So like, let's say you'd have a 1,000 or 2,500 or 5,000, again, depending on the size of the building, deductible for other perils. The wind hail deductible can be, either you, let's say, have a 2,500 on other perils and the wind hail could be a 5,000, or sometimes they'll do it as a percentage. And that's where you really have to figure out that percentage versus how much your insured value is. So it's like, oh yeah, it's only 3%, but if it's 3% of $1 million building, all of a sudden 3% is a lot more than you thinking, oh, it's $1,000. So that is something to watch out. There are some carriers who definitely do percentage deductibles a lot, and it's not necessarily something that you have to do, but it depends on who you're working with. If you're in states that are dealing with hurricanes, we don't really get them up here so much, but again, that's part of that wind or named storm deductible. Part of the whole fight with Hurricane Stanley, which happened pretty soon after I started in insurance, and actually some cool stories with that. But part of the whole fight with that was when it made landfall, depending on where it either had or didn't have that named storm thing. There's always a back and forth with that, and that is something that you should pay attention to. As I said, flood is a separate policy. Um, the big thing with flood is, and this is again, you want to check if it's in a flood zone. Your broker should be able to do that for you. Depending on how you're looking at it, there may be even publicly available data on whether it's in a flood zone. A flood zone does not always pop out at you as being a flood zone. There are times that I've seen properties where you're like, where's the water coming from? But if you look at the mapping and how the water flows, if there were something um, you know, uphill, I guess, for lack of a better term. Um, it could be in a flood zone. There's both the government NFIP, which is the National Flood Insurance Program. So there's government programs, and there are also are private flood companies. The advantage with the private ones is that they are not capped per se. So you're able to get some different coverage with that, including some stuff on contents. Um, but again, they kind of follow the same thing. There is somewhat of a cap to what it will cover. Um, the other thing I was going to say with flood is that because, oh, that was what I was going to say. People look at it and it's a 100-year flood, but the reality is, and it depends on what your investment strategy is. But I always tell people on the, if it's something that they're holding for, let's say, forever, or if someone buys a home, and you assume that they're going to live in it for 10 or 20 or 30 years, a 100-year flood is a 1 in 3 chance if you're living there for 30 years or if you're owning it, right? So that they look at it as like, oh yeah, it'll never happen. It's one in 100, but it's not 1 in 100 because you're not just having 1 year in there. Um, and as Nicole mentioned with the fires, right, these are all different perils that, again, depending on what state you're investing in and what areas, what the different risk profiles are, those are things that you should look into. There is some really great stuff out there to pull, and it depends on whether your broker has it, or if you are doing the research and there's market research in your area where you're looking. There's definitely tools out there that kind of track all of these perils and what the prevalency is in a given area, and that can kind of help you structure how you want to deal with those different risks.
So,
Okay.
as an
Yep.
FYI, for most of my buildings, when I buy, we get a phase one environmental.
Okay.
And the phase one environmentals always cover flood, wetlands, things like that. So you can get a sense on your environmental studies or phase ones if there's a flood risk
Okay.
and where it would be coming from.
Yeah, I mean, I had a guy who had like he called me and he was like, they're killing me on this policy because they say I'm in a flood zone, but I've looked at the map and it's not there. And then I did some deep dives and went and checked some maps, and it was literally like the back corner for like 3 feet next to his
Yeah.
property line. And we ended up what's the right word? There are different ways that you can appeal it. There's a LOMA and there's a elevation certificate. There are different ways that you can do that, but we ended up appealing it and getting it removed, because it literally was like 3 feet in the back of the property that wasn't even near the house. Oops, sorry. Just checking the chat there. Okay. Umbrella insurance. So again, we were talking about liability before. We all see these sensational verdicts, whether they're jury or otherwise, and we all see a lot of advertising for personal injury attorneys. Um, what happens is you have whatever your general liability limits are on a given property, and assuming that you get one of these crazy claims, where they don't just settle it and it's not within the limits. If, as we said, the limits are the cap, so to speak, on your coverage. So contractually, they're only required to cover, up to $1 million, let's say, on a regular policy. An umbrella, the ability of an umbrella is you're buying excess liability. It doesn't kick in until you have exceeded that threshold, but it gives you the ability, let's say the lawsuit settles for $1.5 million, you're not out of pocket for $500,000 because you have another million or two, or again, depending on recommendations and depending on, what size building or what size portfolio it is. You may have, I mean, we've seen people with larger portfolios who have a $10 million umbrella. It really depends on, what your concern is and your risk tolerance, but it's the ability to add a layer so that if somehow your policy limits are exceeded, it's not coming out of pocket. This is an important one that most people do not understand. I didn't mention this when we talked beforehand, but I do want to put this on here, and I'm sorry that this is grainy. I grabbed the graphic for it and really could have typed it out myself. But this is why insuring insurance to value, ITV, I'm sorry I didn't fix that down there, but you really should have updated values on it. And this is why it's important, because most, if not all, property policies are going to have a co-insurance clause in there. which basically requires you to have either an 80% or not. So let's say it's an 80%, which is pretty common, 80 or 90. Um, so if you have $1 million replacement cost on there and you have an 80% coinsurance clause, it needs to be insured for $800,000 at a minimum to avoid the penalty. But let's say you only insured it for 600,000 because you never updated it. Since it's lower than 80% of what the replacement cost is, there's going to be a coinsurance penalty. So if there was a $300,000 loss, sorry, follow along with me here, then they would get 600, right? They would get 600,000 divide, right? They're dividing that times 300,000. So you would have a 75,000, less I need deductible, obviously, but basically you would lose $75,000 on this claim because it's $200,000 underinsured. And where we really see this come up is if you never update property values, if you do improvements and it doesn't get updated. So like people who let it, right? If you bought a policy when you started and they didn't do a good cost estimator, or you did improvements and they never updated like a lot of policies will have a kind of climbing inflation guard kind of thing in there, but that's only like 4% usually on average. And that just kind of keeps up, and you'll see it every year. It's like, oh, well, last year we had it insured for 1,000,001, and now it's 1,001,050,000, right? But it's really where people are either trying to lower premiums by insuring it for less, because obviously that strongly influences what your premium is, but it doesn't help you because then you lose on the claim side. So, I mean, I can send out the actual formula if anyone wants a much clearer PDF, but the basic theory is that if it's not at 80% of what the value is at the time of the loss, you're not going to get the full payout. And that is something that you should definitely think about, because saving, you know, 1 or 2,000 bucks to, knock off a little bit of coverage so that it's cheaper on the front end, losing $75,000 if you have a catastrophic claim like that is not ideal and could probably cost your building. Oh, sorry. One other thing that I did not put on the slides, but I wanted to mention is that there is systems are really important. And let me just pull this up, see if I can share this one. There. Do you guys see this?
No, we still see your PowerPoint. You may have to, if
Okay.
you share just the PowerPoint screen, you have to go back up, unshare, and then reshare.
Okay. I mean, I can just read off of it. You can still see the
Okay.
PowerPoint. That's fine.
Yeah.
Sorry, I'm working off an application here, and that's
Right.
why I just wanted to say how this is going to affect it. But, a big thing with insurance companies, because they're trying to reduce their risk, is when systems have been updated. So the systems that they're looking at are the roof, boiler, plumbing, electrical. These are all things that they're going to really look at. And especially on buildings, it's going to influence, which carriers will take the risk. You may end up in an excess and surplus market because, you have a 1960s built building that doesn't have sprinklers, or, no one's touched a roof or the electrical in a while. There are different things to look for when you, go tour a building. You don't want to necessarily have old electrical stuff. If it says Stablock or Federal Pacific on the breakers, don't do that. Aluminum wiring, there are ways to remediate it, but some investors, if they're doing it for a long term, will fully remediate and replace it, because again, it's going to limit your options, both in terms of it's going to be more expensive to insure, and you may end up in a market with less coverages available because those have been proven to be more risky for insurers. They have this tendency to catch on fire. So that is just something to think about also. And I'm going to go to the last slide here.
Just real quick,
And if
in
anyone
terms
has
of
any questions,
the co-insurance part, I mean, I totally get it, right? So on the
yeah,
one hand, you as the property owner, you're in business to make money, so you're trying to save, right? I mean,
yeah,
Nicole has said this one time that, us real estate investors are probably the cheapest people on the planet, right? Which might be accurate, right? But
yeah,
on the one hand, I get the insurance company side as well. It's like, well, look, you've been paying us a premium based on your value being 600 grand. And now you're asking us to pay more because the value is more, but you haven't been paying us that premium. So
right.
I mean, I hate to say it, but I get it. That makes
Yeah,
sense.
it's partially to
Everywhere else.
recoup it, and it's partially
Right,
also because again, it's almost like a lack of, again, I feel strongly about this, but like the transparency aspect,
right,
it's like, look, we're trying to all operate in good faith with each other. If you're going to say it's worth half of what it is, like you're not helping us have
right.
you set up for success.
Yeah.
And so like that's how a lot of this happens. A lot of the liability lawsuits that you see now, it's like people go and buy the cheapest thing possible, and they're like, oh, well, why doesn't it? Because you wanted to save $5.
Yeah.
And the whole thing could have been avoided. And then you get into all like, why are prices going up? Well, they're going up because we have to cover all these settlements that could have been avoided if people just paid for the coverage in the first place.
Yeah.
Um,
No, that makes
um,
total sense.
yeah, so no, it's unfortunate. People always like look at that and they're like, oh, they're coming back. They always want to. It's like no, there's everyone wants. It's the same thing with deductibles. It's like they want to know that you have skin in the game, also, right? If we're going to take on the risk for your $1 million property or 10, whatever on larger properties, we want to know that you're taking care of the building. We want to know that it's insured for the right amount because we're on the hook for it. We want to, if you take a higher deductible, because if it's a maintenance thing, you're going to replace it yourself, which a lot of property owners will because it's just not worth having the claim on your record, it's not worth, right, going over it, right? It's like the people who submit claims where it's less than the deductible, it's like you're paying them to write you a check. It doesn't really make a lot of sense. So,
No.
like, if you're not going to make a claim for less than, let's say, $10,000 because you'll just have your maintenance guy fix it or you'll do it however you're managing it, then you should take the higher deductible. It'll help bring down your premium a little bit because it shows the insurance company that you have skin in the game. It's not like it's a maintenance policy. It's a catastrophic product policy. It's like, oh yes, if we had a fire that knocked out a bunch of units,
Mhm.
we're going to make a claim. That's what it's for. It's not because someone, broke a window.
Makes total
So
sense.
two quick questions then.
Sure.
Number one is in terms of replacement value, who determines the replacement value? Because you can't see having somebody come out all the time and tell you, what it would cost to replace it. So how does one determine replacement value? And I can see insurance companies having arguments with you about what the replacement value actually is. Um, so kind of how does one work through that?
Okay. I can get the
Um,
second
and
question, and then I'll go from there.
yeah, and I'm gonna can you go ahead and answer that one, and then I'll come back to
Okay.
the second question.
Sure. So replacement value, at least on our end, there are a bunch of different cost estimators that you can use on the insurance carrier side. Um, and again, you can always discuss with underwriting whether you think their number is too high, too low. For you, there should be, as an investor, there should be a, it used to be much easier to do it, just to have a number per square foot, but you really want to know what it depends on where you are and
Yeah,
like the quality of the construction. So, I used to have a rule of thumb that, let's say it was in certain area, it was, I just assumed that it was going to be $200 a square foot for replacement cost. That number has shifted as materials and labor went up. And so now you kind of have to reverse engineer that and kind of figure out what it is in the market that you're investing in. Again, if you think that a number, and sometimes you'll have this where it will come back, the insurance company will come back and say the property is worth, $2.5 million, and you're like, how? And so, you can obviously submit like why you think that it's not and say, well, this is what it would cost me to replace it per square foot. And sometimes you can actually win that fight. Um, it's there's no perfect math to it. I can
yeah,
put it with three different companies, and each one would have their own number for what their replacement cost is. It's really trying to figure out, in the event of a total loss, what it would cost to put up that building again. And again, the biggest thing that on the investment side is hard is that you're buying, let's say, something that's older or something that that you didn't build. Um, you're going to have to deal with the fact that codes may have changed, that materials and labor may have changed, and all that stuff. So that's calculated into there. And so, yes, obviously you bought the building for, let's say, $1 million, but if you were going to put up the same building again in 2026, it's going to cost more than that. So that really is where that math comes from. I mean, again, that's something you want to talk to your broker about. they're going to get a replacement cost estimate. You can definitely challenge that. You can definitely discuss it back and forth. But usually that estimate is, again, based on all those factors that go into figuring out what it would cost now, not necessarily what the market value of the building is.
Yeah, okay, thanks. My second question is really more a comment slash
Okay.
question. So, I remember back when um, we had something that was going to be close to a claim limit, or in terms of replacement of we had a windstorm and several trees came down on top of roofs. And so it was when we called the insurance, we ended not actually putting in a claim, did it ourselves, but it ended up on our record as a claim and they wouldn't take it off.
Okay. So it is something that we see happen. Interestingly enough, and I've seen it, it depends on how the insurance company looks at it. Um, and that could have lots of different moving parts. If there's a $0 claim, usually it's not going to affect you from a premium standpoint. A lot of them will have thresholds where if it's not above whatever it is, and again, that depends on each company, it's not going to necessarily affect it because there's no official claim there. What they're tracking really is risk. And if they realize that there keep being these incidents that you have to put them on notice for, they want to know about those. What we've actually internally for certain clients that have a lot of these things that come in, we kind of filter them. And so they'll let us know and we'll say like, okay, this is something that should be submitted. And it's like, no, this is maintenance. Because oftentimes people just see something happen. They're like, oh, I'm going to call. And then you get dinged with those like, oh, it's on there. It's like you told us there was a claim, but we're going to put it on there for $0 because we didn't end up paying. And yes,
But
sometimes that could affect it if you go to shop and you see that it's on there, but most times you can talk to underwriting and just be like, look, that's not a claim. That's they put them on notice.
yeah, that was what
So
I was going to
definitely,
say because it shows up as a claim when other people go looking. So it has shown up as a claim. And so is that not true that even if it's $0, when you're just looking at it, it still shows up as a claim?
depending on how they put it in, yes. So again, and that's why you don't want to submit it as a claim right away. You can say hey, there's a possibility where you put them on notice that it may happen, but it's not submitted as a claim.
Okay. So it's kind of buyer beware here a little bit.
Yeah,
When
a little
you
bit. And again, that's the type of thing that if you on the broker side, it's the type of thing where if you call your broker when something happens, like yesterday, we had lots of wind. I don't know where everyone was yesterday. I was like the guy who got the alert. I was sitting right here at my desk, and I'm like, half of me wanted to go see how it was outside, and half of me wanted to go down to the basement. So I, went to my front door, watched the clouds for a little bit. It got windy, and I went back inside. But that type of thing, and then I drove around, and depending on where you were, there were worse spots. But after that storm, there are gonna be a million people who call in and say, "Oh, this tree fell here, this thing," right? And it's like sometimes just running it by someone who can tell you, like, that's worth submitting a claim for. Let's sit on it for a minute just to figure out whether it's even something that they're gonna pay out on and not ding anything, or if it's something that you're just gonna fix yourself. Sometimes just, because the broker is able to do the first notice of loss. So like if it's something where you call in to a broker and they're like, okay, this is what happened, get the details, whatever it is, they could technically inform the insurance company for you, or you could do it yourself. It really depends on that relationship. And sometimes they're going to want details that you don't have, I'm sorry, that the broker doesn't have. So they're going to have to talk to you anyway at some point, but sometimes they can do it. And if you kind of discuss it with them, it's a little bit more strategy.
Mm,
Um, for example, like when sometimes people will call you and they have something, let's say their toilet backed up. They have water and sewage backup on their policy, but if they would call without calling their broker first, they'd be like, "Oh yeah, my apartment flooded." And the second you mention the F word in insurance, all the sirens go off. So like if you call and say like, well, okay, you discuss it with your broker, it's like, well, what happened? Oh, well, the power died and then my sump pump blew up and okay, well that's a totally different discussion with the claims adjuster than saying the word flood. And so sometimes it's just like kind of having that buffer where you figure out how to best approach that conversation.
Thank you.
Yeah, no problem.
Any other questions that for Ben? Well, we have him here. So I think one of the things that's, and please, we have a small enough group, you can unmute if you'd like, but I think one of the critical things, especially now that insurance has gone up so much, um, that I think is really important. Like in a lot of things, you can get burned, I would think, right? It's like buying a building. Somebody thinks it's worth X and they bring it to me and I'm like, it's really worth Y, kind of
Yeah.
thing. Or the same thing with Nicole, that kind of thing. So when it comes to insurance, right? I guess my thought process is, all right, I've got one insurance over here for, $1,000 a month. And over here, it's $900 a month. All right, well, this was $100 cheaper. It looks about the same as opposed to, something, maybe I want to run this by Ben because he'll look at it and go, well, the reason this is $100 less is it's not just the deductible. It's like, look, if you look here on the exclusions that I found on page 872, kind of thing. So I think it's a huge, I'm not, just trying to flatter you, okay? But I think there
No,
is
it's all
huge
good.
value in
Yeah.
having someone that is in that space guide you, even if you end up going, oh wow, you know what? If I hadn't talked to him, I would have saved $100. Yeah, but you know something, in 5 years, you would have been out $50,000. So
Right.
I think expertise is hugely critical in being successful in this business specifically, but so much in insurance. So I think you're a great resource, Ben. We really appreciate you.
Thank you. My pleasure. If anyone wants to reach out, I'll throw my
Yeah, please.
contact info in the chat.
And let's see. And then I'll ask you later about the deck if you want to do something with that with your contact information,
Okay,
stuff
cool.
like that. You can do that as well. So, all right. So just real briefly, I think we talked about this in the very beginning, right? So part of the process here was the ability to share information with individuals, to give them an opportunity, A, to learn more, and B, if they want to move forward into multifamily, I think, having someone that's been doing it for 30 years across the United States successfully, right? A lot of these guys are losing money. You probably see it on the news and stuff like that, but has done it successfully for all these years is a huge win. So if you wouldn't mind just kind of let me share this with you for a quick 2 minutes. There's Ben's information there. If you guys would like to copy it, just do this. Place current share. And let me find. All right, here we go. All right, so just let me show you. So this is the class that I basically took, 10 plus years ago, on steroids, if you will. It's pretty much everything you could possibly think of. And there's all sorts of stuff. It's just passivecashflowforlife.com, right? So you can just go there. It talks a little bit about the course. Here's Nicole's lovely picture. Here's my not so lovely picture, and all the different bonuses that come along with the class and stuff like that. Um, should you choose to join the community and take the class, right? What it'll do is we'll actually take you to our new community webpage, and we're actually going to offer this community to everybody. And then if you're a student, then obviously you get access to the classes as well. So we'll probably launch this next week. But when you actually log in, right, it'll take you here. And this is basically our community of experts answering your questions, right? So I'm going to be in here all the time. Nicole will be in here. We'll all be in here kind of answering your questions as you go. So if you're in here and you're part of the community, you go, hey, you know what? I'm looking at so-and-so and I have a question on this. Can someone please answer it? You put it in here, that same day or the next day at the latest, you'll get some kind of response. And the way we've tried to do it, and obviously we'll, adapt as we go, but there's all sorts of different channels in here, right? So special announcements, market trends, what markets are doing well, what markets are not doing well. If you're a private student, if you have just support questions in general, here's our live meetup, Community 101, just some basics and stuff like that. And then Teaching Tuesdays, as we continue to do this, we're going to take all the old Teaching Tuesdays from a couple of years ago and the new ones, and we'll actually list them here, and you'd be able to go, hey, you know what? I really like that guy, Ben, that I, heard like 6 months ago. What was his video? So you can come in here, right? As a student or not as a student, doesn't matter. You'll have access and you'll be able to come in here and click on it and just it'll have an index at the top and go, okay, insurance, there it is, and just scroll down, click on it, and you can watch him. His contact information will be there and everything else as well. We've got a calendar in here for you as well. And then from a learning standpoint, this is basically once you first get in, this is pinned to the top. It kind of walks you through everything in the community. And from a learning standpoint, when you click on here, right, we'll have several things. This is the current course, right? And over here is we're going to have different freebies, if you will, about different things. So we'll have like our goal setting worksheets and a whole bunch of other stuff. We'll just keep adding stuff. But when you actually sign up for the course, this is kind of what you get. So there's 36 modules in here. There's 60 hours. You're not going to get through it in a weekend, I promise you. I've done other people's courses just to kind of see what everyone else is doing, and I've gotten through them in a weekend, and it's unfortunate. But anyway, this is going to take you a while to get through. But the nice thing about what's been created here is that it covers everything, right? From the very basics of, getting ready to invest, right? To how do you find your market? Commercial real estate's a team sport. Oh gosh, I don't know. I didn't know that. How do I build my team, right? Okay, great. I'm going to start looking at properties. I don't want to spend 2 hours like I used to underwriting. How do I look at this in 10 or 15 minutes and decide if I want to move forward to the next level or just kind of walk away from it? Negotiations, especially today, are critical. A lot of creator financing out there and stuff like that. How you actually acquire properties, how to buy apartments and small multifamily, analyzing the deals, right? So you kind of looked at it and did a quick sniff test that we teach you above, and it's like, all right, great. Let me now figure out if this is really going to be a good deal long term. Self-storage we do as well, more analyzation. I'm not going to bore you with all this stuff, but mobile home parks, different exits, right? Our spreadsheets, repositioning, which is basically commercial speak for rehabbing commercial properties. Somebody just called me about one today. It's a 32 unit in the city of Baltimore, God help us, that is totally vacant that she wants to redo. So I'm going to maybe help her with that. Syndications, right? If you're going to buy something big, no matter how much money you have, if you grow this business, you will run out of money and you will have to have other people come and invest with you. And there's legal ways to do it and not so legal ways to do it. We teach you the legal ways to do it, right? How to talk to investors, how to raise money, how to market for investors, how to finance deals. I mean, there's just everything's in here, due diligence, and maybe the most important part, and Nicole, if you can talk to this at the end, I would appreciate it. No matter how good the deal is, if you're going to make your money managing the property, especially if you buy value add, and you can find a property management company that can take a stellar property and put it in a hole in 6 months and vice versa. So from a long-term, I'm building a legacy kind of thing, property management is so incredibly critical. And Nicole's been doing this for a very long time. She actually owns a property management company out on the West Coast as well. So really, really understands the nuances behind successful property management, which is where you're going to get all your cash flow. And there's a ton of other stuff in here as well. But Nicole, did you want to kind of touch on the importance of property manager based on kind of your experience? You might be on mute. I'm not sure. Yeah, you're on mute, I think, Nicole. Oh my God, I put her to sleep. It wasn't you, Ben, it was me.
Sure, it wasn't.
She might have an issue with her microphone. So, oh, there he is.
Okay,
Hi.
there
Hi.
we are. I
Okay.
forgot I was on mute.
Okay.
So I was just basically saying that in terms of acquisition, if you if you don't buy it actually at the best price, time takes care of a lot of things with increasing value. And so if you hold it, it's going to increase in value if it's managed right. If it is not managed right, it loses value no matter what else is going on. In my opinion, in the long run, management is more important than anything else. How you actually not only manage a property, but manage the business of real estate. So you are buying $1 million, $2 million, $10 million business in a property, and you better darn well know how to manage that business. both managing the property in terms of, keeping it up, managing the residents, but also managing the business part of it. And so I actually think if you were to ask me what I'm better at than anything else, it's management. And I think that's why I have a number of successful businesses. And so that's my bias. It may not be true, but that's my bias.
I agree 100%. So, all right. So we're a little bit after 8 o'clock. We sorry we kept you a little bit late. So any questions for Nicole or Ben or myself that we can answer for you guys now, or you can reach us, Ben has put his information in there and we'll send something out with his email on there as well to you guys. Or you can reach us at support at Passive Cash Flow for Life. But before we let everyone go for the evening, number one, thanks so much for trusting us with your time tonight. We enjoyed having you. And if there are any questions, last minute questions, anybody?
No, but I would tell you in 2 weeks, come back because we've got phase two of buying a property. And if you want to buy a multifamily in 6 months, what do you need to do? So
Outstanding.
2 weeks ago, we talked about, um, the first 3 months. And then the next time, we're going to talk about months 4 through 6 and getting that property assessed and closed.
And that the recording of that video is actually up on Teaching Tuesdays on Passive Cash Flow for Life on YouTube. And by the next time we all get together, we'll be in this platform, and all you have to do is click on the left-hand side. You'll see Ben's information, her information, all that good stuff on there. But anyway, otherwise, again, thanks so much. Stay safe out there. Hopefully, if you're in the Baltimore area, no more tornadoes. But have a great night, everybody. Again, Ben, thank you so much. Really appreciate you.
I guess.
Night. Thank you, Ben.
Thanks, Nicole. Thanks, James.
Good night.